Tomas, we are back, my friend. You know what that means. Time for Chris Vecchio, and let me explain. Welcome to the show, Chris.
Gentlemen, happy holidays.
Happy holidays to you, too. How's everything in Nueva York, right? Weather-wise, everything good?
Now it is. I mean, there was definitely some flooding yesterday. The flooding was so bad that they actually canceled school for my daughter,
that's what I heard. Yeah,
which was fun. But yeah, nothing like having a child at home unexpected on a work day. But you make do.
No time
Everyone's
for mommy
okay.
and daddy.
Yeah, great.
Those days are over, Beth.
Yeah.
Look at this little Russell rally right here.
Yeah, Russell up big, up almost 2%, $34.40, up a buck,
Get
one in the order.
this little Russell rally. Hold on, Mr. Vecchio. Before we start, I am going to roll up some here. Ready. Putty. Okay. What you got for us today?
Well, it is the end of the year, which means it's finally time to talk about the purported Santa Claus rally. You've heard in financial media probably a lot over the last several weeks and months. Well, we'll go back to November, that this was the Santa Claus rally. I take an issue with that because the Santa Claus rally is a specific term coined in 1972 by Al Hirsch of the Stock Traders Almanac that looks at the outperformance of markets in the last 5 days of any given year and the first two of the new one. And there is a statistically outsized performance of markets during that period of time. The S&P 500 may be up 24% year to date thus far and up nearly 5% this month, just spitting distance of the all-time highs, which in the continuing contrast, 4808.25, I believe we were at 4805 earlier today. We are well poised to see another strong rally through the end of this year. More gains may be yet ahead. The Santa Claus rally, observed again first in 1972, looks at the data available since 1950 in the S&P 500. Nearly 80% of the time, including last year, the S&P 500 has gained ground to the tune of 1.4% during the final 5 days of a calendar year and the first two of a new one. Last year, the S&P 500 gained 0.8% over that window. So for whatever reason that may be, if it's for tax loss harvesting reasons, it's for people redeploying capital, trying to paint the tape and window dress their performance into the end of the year, we don't really need to provide a reason for why it happens. But nearly 80% of the time, markets like to rally very strong at the end of any given year, and that performance tends to be accentuated in good years. So as we look to next week, while this is a market where volatility is very, very low still for most equities, save the Russell, which granted has an IVR when I last saw was up closer to 27, 28 compared to the NASDAQ and the S&P, which were both under 5. This is a market that could see those gains scratch and claw, inch their way up in a classic melt-up type of situation. The last 2 weeks may not be the most exciting time of the year, but starting this Friday through the end of next week and the first Tuesday and Wednesday in the month of January, the table is set for stocks to continue their strong run. Technically speaking, Tom, I know that you're not a fan of technicals and perhaps even fundamentals, which I've been told we're going to debate at a later time, but the data is clear. And given the setup in this market where momentum is very, very strong, there are a meaningful portion of traders that are still holding net short positions as of the CFTC's most recent COT report. Some covering into year-end can help drive stocks to the upside. I see no reason, as it were right here, to take anything other than a bullish view. If you're in this market, if you're looking to dip your toes in for the next 2 weeks, how do you short something that just is about to hit all-time highs? And the NASDAQ and the Dow Jones are already there.
It's incredibly difficult to be short right now for all the reasons you just discussed, which is probably why you have to be short. I mean, I'm not saying it. I'm not saying it just to be like the ultimate contrarian, and I'm not saying it just to play devil's advocate or to be difficult. But Chris, one of the things I've learned over the years is that, when we play Master of the Obvious, which is a board game, with the stock market, it never works out. Right? Like there's nobody that can look at this market where it currently is right now and think any differently than what you just described and what you said. Now, that's just looking at it. But as a trader, it is extremely difficult when I look at this market. And again, I'll buy into everything you just said, except risk reward wise, I absolutely despise the play. Now, I know over time that the problem with the whole Christmas rally thing, we just did a thing on seasonality, about less than an hour ago. And, I mean, one of the reasons that the whole December, the results of December turned out to be as kind of as uninteresting as random as, because there's certain years where there was just, 2018 being the main year where December, the sell-off in December threw off the numbers for, basically an entire decade. But that said, I think that anytime, I think right now the market is extremely comfortable in being long, and everybody's extremely comfortable with their positions for the next week and a half. And very rarely does that kind of comfort lead to the opportunity to get out, with certain, I've just watched this for way too many years. I've been involved way too long with this kind of, with this kind of a setup, this kind of situation. And when you least expect it, again, it probably, statistically speaking, just like you said, it will probably play out. But for me, the upside, relative to as a trader, relative to the potential returns that what I'm risking to make, I think I'm risking a lot to make a little. And I think on the other side of it, I'm risking a little to make a lot. And so when I look at this market from a pot odds standpoint right now, I think you have to be crazy to be long going into the last 8 days of the year, 7 or 8 days of trading days of the year. I think right now you should be taking profits and taking profits and leaning short.
We haven't had a downtick.
No, I understand. That's what I'm saying.
I mean,
yeah, I totally understand. Listen, we hadn't had a downtick.
I like your scenario.
We got short Costco yesterday because we hadn't had a downtick. We got, we sold. We did the Nasdaq Russell yesterday. We bought Russell and sold Nasdaq because we didn't have a downtick in that. I mean, we are contrarians, and
Agreed.
to be true to what we do, we have to get short here.
But instead of talking about Santa Claus rally, let's look about it as a little bit of a proactive. If you have long delta in something like a covered call, I'm only saying covered call because it's the easiest strategy that people most trade. For me, I would look, because it has a lot of downside risk, and we've only had up days. I would look to close that by a call spread at the money if you want to, with the limited risk, or sell further out of the money put, or put spread. I would take what the market is giving me and try to minimize my risk that way, as opposed to looking to get short delta or anything else.
I'm just talking pot odds. Chris is directional. I'm being directional. This is a pot odds situation here. Rarely, Chris, over the course of a year, when we talk about price extremes, and over the course of a year or 2 years, whatever it is, 5 years, you rarely get upside price extreme like we're experiencing right now. It doesn't happen that often. Sometimes it can last for, 35, 40 days. It can last for a month and a half, 2 months. But however it resolves itself, usually from a pot odds perspective, I think the play is on the short side here. That's all. I don't think it's going to happen today or tomorrow. Who knows? But you can't. I don't like the risk reward. That's all. It's just a risk reward play. I think you're risking 3 to make 1, or you can risk 1 to make 3. And I like to risk 1 to make 3 better than I like risking 3 to make 1.
Well, one of the reasons why the market has been up is because retail traders have been pouring money in from off the sidelines. I know the whole concept of money on the sidelines seems ethereal for most people, but people stash funds in money market funds, for example, in bank accounts where there's been higher yields. And so that cash is effectively idling. And so people have been starting to draw down some of those money market funds and redeploy it into the stock market. On Friday, SPY, the S&P 500 tracking ETF, took in $20 billion, which was the single largest day of ETF inflow for any ETF in U.S. history. Yesterday,
and that doesn't scare you? That makes you bullish as opposed to scaring you?
Well, I'm in the middle of my, spiel here.
Okay.
We can get to we can do the shoots and ladders thing where we just jump to the end.
Okay.
But yesterday we took in another 10 billion. That's 35 billion that's come into this market over the course of the week. There's only 49.8 billion that's come into SPY this year total. So that's a lot of money that's come in a very short period of time. So I would agree with you. If I'm thinking about what happens over the next week or two, I think that this is a market that has the flows propping it up right now. However, if I'm thinking about this market in the typical Tasty fashion, if I were to initiate a trade today at a 45 DTE, I'm holding it until 21 DTE. Would I rather be long or short? If I'm scalping for the next week or two around the holidays, I think the prevailing tailwind is to be long. But if I'm thinking longer than that, as we saw with bonds in October, which was a foundational piece of why we thought the bond market was bottoming out, record number of contracts traded in ZB. Hadn't seen that kind of volume in ZB until you go back to late February 2020, early March 2020, when you have the peak in the long end bond. Mm-hmm. This feels like this is a capitulation point that's being reached right now in the market. We're seeing the exhaustion of flows coming in. The money is coming off the sidelines now. And so if I'm thinking about expirations that are later in January, early into February, it would behoove one to think that the odds are leaning for the downside a little bit. People are chasing here into the end of the year, plain and simple. But when you get into 2024, when vol is on the floor, when yields have come off substantially, when there's this whole attitude of the Fed's going to cut rates 6 times next year and the economy is not going to fall into recession, one of those two things has to give. So there probably will be a repricing in this market. So do I disagree with you that the pot odds are I should probably be thinking about some short opportunities? I don't. It just depends on your time frame right now. Through the end of this year, staying long, if I'm looking at a time horizon into 2024, I think you need to consider the fact that this is a market that looks a little top heavy and the boat is pretty full of people right now after the ETF inflows we've seen the past few days.
Yeah, no, that's my point exactly. And so the reason, what I've learned about this business over a long period of time is that you don't get rewarded for being a hero and being the one who can, last the longest. Like you don't get rewarded to seeing how far you can go on an empty tank of gas and seeing if you can, right, squeeze the last, half a mile out of it. It's not worth it. So I think there's a lot of red flags. You just talked about a couple of them, but also remember at market tops, you're not going to get the kind of volume capitulation you would get at market bottoms. So it's very different. Like when the bonds bottomed out, you had huge volume capitulation. You're not going to get that, going the other direction. But again, right now, until
further notice,
there's no play there. I mean, the market's not, just look at these stocks. I'm just looking at my watch list and, there's,
pick a stock, any stock.
Yeah, it's just a rotation today. I mean, Nvidia and Costco are down and everything else is up and welcome to the end of 2023. It's just, you just have to kind of, these are the tough days for directional players. Mm-hmm. For non-directional players, the risk in being short premium here is just that, vol's gotten to a level where, it's not moving. The VIX futures are literally not moving. They're basically down a penny today. They're just not moving. Right. Rallies don't send VIX futures lower right now, which is another, huge red flag. But again, it doesn't mean can't be, could be a week away, could be 2 weeks away, could be a month away. I remember in 2020, which was another election year, going the end of the year into all the way into the end of January. I mean, it was just, that rally was brutal up until the week after January expiration of 2020. I mean, there wasn't a downtick. We made record highs, all that kind of stuff. And then, then the pandemic hit, then basically crashed. But, I mean, so this happens a lot. It was just 4 years ago. I mean, this is pretty typical tape action. All right, let's go next topic. I think we beat this one to death, but it's good. What do you got?
Well, there's geopolitical risk premium that's been coming back into this market, particularly in energy. I know that we've had these discussions over the past 2 weeks about looking to sell puts in CL because of where we find ourselves in the chart. And quite frankly, the IVR profile is much more appealing than looking at ES or NQ. And there has been a nice little rally here. For those that have been doing this, it's been a rewarding week or two. Mm-hmm. But there's been some news here that's driving this. It's not just simply because of concerns over global growth. For many people out there, they should be paying attention to if this is something that interests you if you're trading CL or NG. what's happening in the Red Sea. Why do we care about the Red Sea? I don't think we've ever talked about it before. The Red Sea leads up to the Suez Canal, the isthmus in Egypt, where roughly speaking, 30% of goods that make their way into Europe transit every single year. But more importantly, around 10% of global oil supply moves and about 8% of natural gas supply. And so if you're trading these energy products right now, you have to be very cognizant of the fact that because of this now protracted conflict between Israel and Hamas that has drawn in the Yemeni Houthis, there is going to be continued geopolitical risk premium here for the foreseeable future. That doesn't preclude wild price swings, like natural gas is down nearly 3% on today's session. When I last checked, oil was roughly speaking unchanged. But it does mean, knowing that this is now a hot button issue in the world, it's very likely that the volatility that we've seen built into the space sticks around for a little while. So whereas equity vol has come down and is staying low in ES and in Q, where bond market volatility has been slowly eroding away over the past several weeks and months, really going to the start of October, energy is one of those singular places in the market, if you're looking for trading opportunities over the next 2 to 3 weeks, where you may be able to see it sustained, not falling off because it's New Year's or Christmas and trading volumes are thinning out in other places of the market. I mean, outside of crude oil, you're effectively looking at 2 other places. You're looking perhaps to copper, which has a very high IVR right now. It was around 63 when I last checked. And then even the Japanese yen, which after the Bank of Japan rate decision, vol has come in a little bit, but it's still north of 25, and currency vol has been on the floor. So you kind of have to take and get while the getting's good. But energy markets right now should be on everyone's radar. I know that we've been talking about it on First Call, and let me explain, in every other program, Overtime, Futures Power Hour, it still should be a primary focus for individuals. And I know there's a tendency to overtrade or to kind of find a trade if you stare at the screen long enough, which in NQ and in ES, that's very tempting right now. But instead of picking up pennies in front of a potential steamroller there, maybe move over to the energy market still. It's a very viable space, in my opinion, and it has been and should be for the immediate future.
The whole concept of geopolitical risk here is interesting to me, because it's funny, when I think of the energy markets, I don't think of geopolitical risk. Like, I know that sounds going to sound weird.
Just look at price. I mean,
yeah, I just look at price. Like, I agree with you that, like, for me, directionally, like, I mean, we're obviously long natural gas here, because as contrarians, you know, I'm not going to sell natural gas down to 230, 240, 250 in that range. You know, I'm always going to lean long delta. I mean, we're short some out of the money calls, but we're always going to lean long delta. It's just the way we trade. Crude oil, on the other hand, I'm trading it delta-less. I'm basically trading it as it's delta neutral. Let me just look at my position, as delta neutral as I can.
And you mentioned IV rank earlier. Both of them have good IV rank.
Yeah, they both have good IV rank. We're a tiny little bit short crude oil here, just based on the rally today, up almost a buck. But I'm trying to be neutral in crude oil, because I think it's a range bound play, and I think got to be short premium there. Natural gas, I think got to lean a little bit long, and copper I'm also short premium in, but I also think copper is a tough trade, just because it's not nearly as liquid as anything else, although it's better than silver. But we have
It's about option markets.
Yeah, the option markets copper. They trade a tick around mid price, so it's okay. When I think of geopolitical risk, Chris, I really think of equity markets. And of course, because 99% of our trades are in U.S. equity markets, when I think of geopolitical risk, I think of U.S. equity markets. And I would say, based on where implied volatility is today, you know, the market is pricing in an extreme low level of geopolitical risk in the U.S. It's pricing in a crazy low level of risk in the U.S., but geopolitical risk is, you know, wrapped around zero right now. And the reason for that, you know, we've talked about this already on air this morning. The reason for that is because neither candidate that's a front runner for the 2024 election is of any danger to the market whatsoever. I mean, the market looks at Biden and says, hey, you know, we're at record highs, everything's great, and, you know, he's just going to do more of the same if he wins, and that's perfect for us. Nobody's going to upset the apple cart. And the market looks at Trump and thinks he's not going to upset the stock market apple cart at all, and he's really more focused on himself, so that's not going to be an issue. So I don't think that Trump or Biden moves the needle at all as far as the stock market's concerned. So no geopolitical risk right now in, you know, I don't think there is in the U.S. and I don't count the oil markets for us. as an active trader, I don't think there's an active trader outside of a profession. Like professionals care about oil because that's where they may live in the oil and gas marketplace. But for retail investors, nah. You know what I'm saying, Tony? If everybody has one or two positions, that's a lot. Like as a percent of our customer portfolios, it's less than 1%. So I don't look at that as customer risk. It's a good story. It's not customer risk.
It's certainly a good story. And I think you're absolutely right about the presidential election. Look, I mean, we've had presidencies from both of these guys before. Trump, for all of his, there's a lot of things that you could complain about him if you don't like him. But the fact is, it was a lot of generic Republican policies when it came to financial markets, plain and simple. Tax cuts and deregulation. Markets aren't going to have a problem with that.
Yeah, I don't think the markets care one way or the other. I mean,
exactly. If Biden's reelected, you're probably going to see a gridlock in Washington, D.C., so you hold the status quo.
Yeah.
So where's the risk for financial markets? And the Fed becomes the primary lever that people lean on, and people are looking at the Fed. But I know that we're out of time. Otherwise, I would have loved to have discussed the Fed with you more. I know that's your favorite topic.
Thank God we didn't get to the Fed. Yes, I'm glad we did not get to the Fed.
Thank you, Mr. Vecchio.
But that was good stuff today, Chris. Thanks so much, as always. And if we don't talk to you, because we will not be doing a show on Sunday night, have a great holiday and enjoy. And hopefully you don't get flooded out. And we'll see you next week.
Stay dry. We'll be back in 90 seconds.
See you in 2024.
More Tasty Live with a market measure next. Back in 90 seconds.